Welcome to vTalkInsight, Market Drivers Daily for February 17th, 2026. Today's session is all about stress points. Europe is grappling with security dependence. AI is straining chip supply and valuations, and equity leadership is fragmenting across regions and sectors. The common thread is repricing, both in currencies and in risk assets, as investors rethink where growth and resilience will actually come from. Over the past week, we have been tracking Europe's shift into a multi-year defense and rearmament cycle. The latest signals underscore that, even as spending rises, the architecture of European security remains fragile and heavily dependent on the United States. Joint projects such as the flagship Franco-German fighter jet are struggling to advance, which raises doubts about how quickly Europe can achieve real strategic autonomy. That implementation gap is central to why European risk premia stay elevated even as governments commit more money to defense. The war in Ukraine continues to inflict severe human and infrastructure losses on both sides, with no clear path to a clean military victory. Some observers now see a negotiated settlement as more likely over time, but the journey there implies prolonged instability and a persistent security overhang for Europe. U.S. financial and military aid has been critical for Ukraine's defense, and any delay or reduction would immediately raise questions about European security and the durability of transatlantic ties. That uncertainty feeds directly into higher required returns for European assets, especially in markets most exposed to defense, energy, and border state geopolitics. At the same time, geopolitical pressure is catalyzing a push toward deeper European integration. Governments, led by Germany, are scaling up infrastructure and defense budgets, creating a fiscal backstop that supports medium-term growth and helps cushion shocks. There is even talk in the Nordics about joining the euro, which, if it ever materializes, would be a powerful signal of confidence in the currency and in Europe's institutional core. Against this backdrop, despite inflation and currency pressures, the European Central Bank appears in no hurry to cut rates. If geopolitics continues to drive closer integration and higher defense spending, that combination could be broadly supportive for the euro over time. Behind the headlines, there is wider unease about the rules-based international order itself. European leaders are increasingly unsure about the reliability of U.S. security commitments, especially given domestic political divisions in Washington. Institutions such as the United Nations, NATO, and the European Union are seen as in need of reform, while some countries call for a more inclusive system that delivers tangible benefits to working populations. Western policymakers are also working to reduce reliance on foreign-controlled supply chains, particularly those linked to China, to lower the risk of economic coercion. Parallel diplomatic engagement with Beijing and tentative U.S.-Iran nuclear discussions are better viewed as risk management channels than as signs of a strategic reset. For markets, the immediate implication is a blend of fiscal support and structural risk. Higher European defense and infrastructure spending underpins growth and earnings in specific sectors. Yet unresolved conflicts in Ukraine and the Middle East, plus questions over U.S. engagement, argue for fatter tails in European and select emerging market distributions. Key watchpoints now are the follow-through on European defense integration, the trajectory of U.S. support for Ukraine, any concrete moves toward Nordic euro adoption, and progress on supply chain rewiring. How those evolve will feed directly into currency pricing, regional equity premia, and the relative appeal of Europe versus other risk markets, setting the stage for how AI-driven themes are expressed across assets. Artificial intelligence remains the structural growth story, but the focus is shifting from pure upside to bottlenecks and valuation stress. Surging demand for advanced AI chips has created a severe shortage in key memory components, with estimated price jumps of around 60% quarter-on-quarter for products such as DRAM. New fabrication plants take years to build, so supply is struggling to catch up, squeezing hardware buyers and inflating the cost base for AI infrastructure. Those pressures are already weighing on corporate profits in parts of the tech hardware stack and embedding a layer of persistent, sector-specific inflation. Despite the intensity of the chip shortage, the macro backdrop differs from the broad inflation surge seen in 2021 and 2022. Current cross-currents suggest that while AI-related components may see sustained price pressure, the probability of a generalized inflation shock driven solely by semiconductors is lower. Even so, AI adoption is expected to trigger both job substitution and productivity gains, with the net effect likely skewed toward higher demand for commodities that power data centers and digital infrastructure. That combination of targeted hardware inflation and potentially higher commodity use is one reason some see the front end of the U.S. yield curve as a hedge against AI-related labor displacement and the risk of eventual overinvestment. On the equities side, AI is now as much a source of volatility as of optimism. Recent advances in AI capabilities have not translated into new highs for the Nasdaq, underscoring investor uncertainty about near-term earnings leverage for large technology names. The software sector has sold off, and while some argue that markets are failing to differentiate between AI-enabled platforms and legacy software, the broader message is that dispersion within tech is increasing. Corporate management teams spend more time on AI during earnings calls, yet there is little consensus on the long-term impact on business models. AI-related corporate issuance is sizable and well-absorbed, but there is growing anxiety that heavy capital spending could disrupt incumbents without guaranteeing commensurate returns for equity holders. Flows confirm that investors are rethinking where to access AI growth. Emerging markets, particularly Asia excluding Japan, are attracting their fastest equity inflows since 2019, helped by both diversification away from U.S. concentration and strong structural AI exposure. Around 30% of companies in that universe are linked to AI themes, and South Korea stands out further, supported by government efforts to lift valuations and by powerful defense and AI-related sectors. Some allocators even prefer these emerging exposures over Europe when diversifying AI risk, given more direct ties to the hardware and supply chain story. AI is also reshaping market structure and access. Advanced AI tools are narrowing the information gap between institutional and retail investors, empowering individuals with analytics that used to be confined to professional desks. At the same time, most early-stage AI wealth creation is still happening in private markets, where retail participation remains limited. Tokenization and evolving regulation are seen as potential ways to broaden access, but these are medium-term developments rather than immediate catalysts. Looking ahead, the key questions are whether supply constraints in AI hardware ease, how central banks interpret AI-driven inflation and labor shifts, and whether a clearer narrative emerges around which business models actually monetize AI. Until then, AI is likely to remain a source of both structural growth and ongoing volatility, feeding directly into the divergent patterns we are seeing across global equities. Market divergence, which we have highlighted in recent days, is becoming even more pronounced. There is no single dominant equity narrative at the moment. Instead, leadership is fragmenting by region and sector as investors rotate away from concentrated U.S. large-cap tech exposure. Flows are moving toward areas seen as either benefiting from AI capex or insulated from its disruption, while parts of the previous winner's list experience profit-taking and valuation pressure. Europe offers a good snapshot of this churn. With U.S. and many Asian markets closed, European trading conditions look relatively normal, yet sentiment is directionless, and recent price action is dominated by rotation rather than trend. European banks are outperforming, up more than 1% in early trade, reflecting renewed appetite for financials despite broader volatility. In contrast, basic resources and utilities are lagging, with basic resources down about 1.3% as metals prices remain under pressure. Miners that had previously outperformed are seeing profit-taking, while banks and earlier laggards attract fresh interest, underscoring how little conviction there is behind any single equity story. Across sectors, the bias has shifted towards cyclicals and away from traditional defensives. Consumer staples, despite roughly 15% gains year-to-date, are now viewed as expensive given their slow growth profile and are seen as less attractive relative to more cyclical areas. Healthcare and financials, both recent underperformers, are thought to be approaching an inflection point, with scope for earnings improvement and renewed sector rotation. Industrial names in both the U.S. and Europe are highlighted as major beneficiaries of rising AI-driven capital expenditure, supported by solid manufacturing data and strong order backlogs. That offers a bridge between the AI theme and the broader value and cyclicals trade. Regionally, capital is tilting away from U.S. tech and toward alternatives. Investors are rotating out of underperforming U.S. AI and megacap names and into European equities and markets such as South Korea, which combine AI exposure with different macro and policy regimes. Europe's lack of a dominant IT sector, coupled with strong showings in financials and industrials, makes it a natural option for those looking to reduce exposure to both U.S. tech and the dollar. At the same time, emerging market equities are drawing strong inflows, aided by AI themes and a softer dollar narrative. India, with its domestic, consumption-led growth and relatively limited linkage to the global AI trade, is seen as an additional diversification leg for those reducing reliance on U.S. cycles. Despite these rotations, this is not a classic risk-on or risk-off environment. Market sentiment is broadly directionless, with no clear macro or policy catalyst taking charge. UK investors, for example, are diversifying more globally across domestic, European, and U.S. equities, but flows appear driven by relative performance rather than regulatory shifts. The key questions now are whether the outperformance of European banks and AI-linked industrials can persist, whether weakness in basic resources and some defensives proves temporary, and how sustained the inflows into emerging markets remain. The answer will depend heavily on how the AI and geopolitical stories evolve from here, and whether upcoming data provide the clarity that risk assets currently lack. To wrap up, European geopolitics are locking in higher defense and infrastructure spending, which supports growth but keeps regional risk premia elevated and the euro narrative firmly tied to integration and security policy. AI remains a double-edged driver. It is fueling chip shortages, sector-specific inflation, and valuation volatility, even as it underpins long-term capex plans and drives flows toward Asia's supply chain and selective emerging markets. Equity leadership is fragmenting further, with investors rotating away from concentrated U.S. tech exposure toward European banks, industrials, and diversified emerging market stories. Yet overall sentiment stays cautious and catalyst-light. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.